Hello everyone, and welcome to the joint IOGP and IPICA webinar entitled Sustainable Finance, Non-Financial Disclosure for the Oil and Gas Sector and the EU Taxonomy in Practice. My name is Jim Herbertson and I am the Technical Director for Climate and Energy here at IPICA. Before we start, I would like to cover a few housekeeping items. The webinar is being streamed through your computer, so there is no dial-in number. Everything you can see, including the slides, is resizable and movable. So feel free to move things around and get the most out of your screen. At the bottom of your screen, you will see some features that are available. You can use the Q&A box to ask questions as we go. Please indicate who you would like to answer the question, either an individual panelist or the whole panel. Also, there is a help feature. But most issues can be sorted by refreshing the page using the F5 key. This is particularly useful if you think your slides are falling behind. A recording will be available later this week and can be accessed using the same link you are using now. And now I'd like to say a few words about IPICA for those of you who are not familiar with the organization. IPICA was formed in 1974 following the launch of the United Nations Environment Programme. We are the only global association for both the upstream and downstream oil and gas industry. Our membership operates worldwide, and we reach about 500 oil and gas companies when we include the reach of our association members. Our work encompasses 4 broad themes: climate, environment, social responsibility, and oil spill preparedness and response. We are the industry's principal channel of communication with the United Nations and work closely with a number of UN bodies. We present and hold side events at the UNFCCC Conference of the Parties, at the UN Convention on Biological Diversity, at the UN Environment Assembly, and at the UN Business Council on Human Rights. One of our recent activities has been to map the oil and gas sector to all 17 of the UN Sustainable Development Goals via our SDG Atlas, which is available on our website. This in conjunction with the UN Development Programme and the World Bank IFC. And we are currently working with our members on an oil and gas sector roadmap for the Sustainable Development Goals. IPICA is not an advocacy organisation. We are member-led and we concentrate on technical and fact-based information. We use our convening power to bring together professionals from our member companies to work together to develop and share good practice. This enables the oil and gas industry to improve its environmental and social performance. We also look to enhance and share knowledge on topics of interest with members and external stakeholders, hence this joint webinar today. I would like now to hand over to Camilla to introduce IOGP, who is jointly hosting this webinar. Camilla.
Thank you, Jim. Good afternoon, good morning from wherever you dial in and join us on this very fascinating webinar. So IOGP, similarly to IPICA, we were created in the 70s. We have 3 offices in London, Brussels, and Texas. My colleagues in London, they develop technical guidance, they collect data, publish performance indicators on subjects like the environment, health management, and safety. Me personally, I'm based in Brussels, so regards from Brussels, where we follow a wide range of subjects devoted to climate, energy policy, air quality, and of course, sustainable finance, which is getting more and more attention. Here in Brussels, we inform the EU policymakers on how the oil and gas industry can contribute to the achievement of the Paris Agreement goals and also how the industry can contribute to the achievement of the EU climate neutrality by 2050. And without further ado, I would like to pass the floor to our excellent moderator, Inigo Palacio Prada, who is a member of the IPICA Executive Committee. Inigo works for Repsol. He is responsible over there for sustainability strategy and coordination. So, Inigo, the floor is yours.
Thank you very much. Thank you everybody for attending this second webinar on sustainable finance hosted by IPICA and IOGP. It's an honor for me to be moderating it, and I hope it will be interesting for all of you. Thank you for being here. Last week, I finished the previous webinar saying that when we talk about sustainable finance, we make non-financial issues become financial. Development has to be financed in order to become a reality, and financial institutions no longer demand only profitability to their investments or to their lending, but they also demand sustainability. A very good way for a certain investor to know if a certain project is more or less sustainable is to see how it fits into a certain predefined classification or taxonomy. The problem is that too often classifying is more about limiting rather than about defining. When we talk about the EU taxonomy, we have to take into account that it is not defined or designed to classify at project level, but it is designed to classify at companies level, at activity level. This can mean that a certain company could be undertaking a good sustainable emission reducing project, but this project maybe could not be eligible for a certain financial tool because of the EU taxonomy not considering the company sufficiently aligned with it. Let me put it the other way. A certain project could be more or less financeable depending on the eligibility of its promoter. This is something that can be happening when we talk about the EU taxonomy with our industry, our oil and gas industry, because activities of exploration and production have been explicitly excluded from the start in the technical report. Refining has not been selected as one of the activities to be classified within the taxonomy. And when we talk about power generation with gas, it is included, but it has to follow up with very tough thresholds if we take a look at them in the short time. This is more or less a brief introduction on how this EU taxonomy can be impacting our industry. Net zero emissions society in 2050 is a huge ambition, and the path is going to be very difficult. We have to go from 33 gigatons of CO2 emissions down to net zero in 30 years, while meeting the energy demand needed for economic growth. Fossil fuels are part of this equation, and International Energy Agency states that oil and gas is expected to have a big stake in the energy cake in 2040, even in the most sustainable scenario, with transport being very oil dependent, with billions of dollars or euros being still needed for financing oil and gas capex and opex, and lack of investments could mean energy supply shortages. The energy transition and not energy disruption is a long journey. We all have started this journey together, and we have to keep on going together. Every ton of CO2 should count from today until 2050 from any source, and regardless of the shade of green. Everybody has to commit to be reducing emissions, and this has to be the overall scenario in which we have to play our important role in this energy transition. Well, this is my introduction to the topics that we're going to discuss today, but it is not me who do this, because we have three fantastic panelists and a lot of people listening to us that might be having questions throughout the Q&A panel in the application. So I just finish here and give the floor to the panelists. We are going to start with our first panelist, who is Elena Viñes, Deputy Global Head of Sustainability within BNP Paribas. Elena is one of the mothers of the EU taxonomy. She is the member of the technical expert group that did all the hard work that was building this taxonomy. Dear Elena, thanks a lot for being with us today. This is not the first time that we are together in an event to talk about sustainable finance. We met digitally or virtually yesterday at the Spanish Energy Club. And well, each time I am with you, I learn something new. So it's for sure that this will happen again today. So I'm so glad that you're here with us, Elena. Please explain to us what's the EU Sustainable Finance Taxonomy. Thank you very much, Elena. The floor is yours.
Thank you. Thanks a lot. Thank you so much, Inigo. And thank you to to all the organizers for giving me the opportunity to present today. I'm actually really, really happy to present because I know how complicated the taxonomy can look and how much more of education with the tech we need to do in order for everyone to understand that horrible report. I would say horrible because it's more than 600 pages. So I understand not everyone has had the time to go through all 600 pages. I'm not expecting you to do that. I'm sure all of you are thinking of taking it with you during that summer holidays and give it a try, at least a little bit every day. Now more seriously, after listening to the introduction, I think there are a few misconceptions or misinterpretations of the taxonomy, and it's really important to get some of the key principles of the taxonomy right and perfectly understood. That's why I decided that instead of walking you through the 600 pages, I'm going to concentrate in sharing with you 5 key messages that I believe are key to understand the taxonomy, and particularly key for the audience we have today. So without further delay, I'll start with the first one. So number one, the way the taxonomy has been conceptualized and designed, what you need to remember is that there is a double conditionality. On one hand, any economic activity can be part of the taxonomy if it contributes substantially, and the word substantially is really important, to the accomplishment of one of the 6 environmental objectives. I'll talk about them in a minute. And at the same time, it does not harm either on one hand one of the other 5 environmental objectives, and at the same time it doesn't harm social standards. Now, here I also wanted to share with you a couple of important points that have been misunderstood. The first one is that, actually 3 points. The first one is that the regulations left and the mandate we had was very clear that as far as we could, that substantial contribution should be expressed in a quantifiable manner, and we should establish thresholds. Now, the second point is that do no significant harm, although there are some quantifiable indicators and thresholds, the vast majority respond to more qualitative, they are directly linked to current EU regulation. What the text did in order to ensure that it was understood also for non-European audience is that we describe the key points of principle of those regulations that they are to be respected. One of the things that we're thinking, looking at the future, is trying to start working so with more equivalence at the international level. Now, the last point I want to make here is that the minimum safeguards at the very beginning, when you look at the European Commission proposal, was limited to the International Labour Organization Convention, so key principles. Now, the final political agreement expanded the minimum safeguard to the OECD multinational guidelines and the UN guiding principle on business and human rights. I mean, for those who don't know, it is a legal international instrument on responsible business conduct. It's been endorsed by more than 50 countries, almost all EU countries. And while they're non-binding for enterprises, the countries adhering to the guidelines make a binding commitment to promote and implement them across enterprises in their territory, whether they are from the territory or they're operating in their territory. So it is already soft law within Europe. The other thing I wanted to highlight is that for evidence qualitative, our recommendation is to implement those through a due diligence process and to to use the recommendations of the OECD on those. And last but not least, the principle of proportionality really operates here. So we are conscious of the task, and we are conscious that, the level of detail or the depth also has to be proportional to the nature, the size, and the context in which a company operates. Now, number two. So the second principle or message I want to do is that if the double conditionality sort of frames the taxonomy from a technical perspective, from a conceptual or philosophical perspective, the taxonomy is framed by two pillars. So on one hand, EU environmental objectives, so EU policy, and by the other, on science. And this is extremely important because the 6 environmental objectives that you have in front of you are the 6 environmental objectives of the EU on the European environmental plans. For each one of them, there is a strategy and there are clear objectives. In some areas, so for example, on circular economy, the objective that we have today, so before 2030, we need to double circular material use rates. Now, what we also know is that this year the Commission, so the EU, committed to develop a strategy. We just seen the really strategy on biodiversity, and there's an adaptation that also envision a revision of the strategy. But basically, for each one, what I'm trying to convey here is that for each one of the environmental objectives, there is a strategy, or there's going to be a revised strategy with clear objectives for 2030, generally for a midterm, and then by 2050. Now, how the taxonomy works is that the thresholds need to ensure that the long-term and the mid-term objectives are met. And what is going to inform that is science. And this might explain and brings me to my third point, which is that the taxonomy guides the transition. So as you all know, the EU has a very clear objective of being carbon neutral by 2050. It's going to be enshrined in law. This is what currently the European Parliament is debating. And but also the taxonomy regulations also told the tech, and it was very clear, is that for us we have to draw a pathway to limit temperature increase to 1.5 degrees Celsius above, and that means if we listen to science, and the tech very much supported its work, or better said, the 2 reports that really fed into the text works were the IPCC 1.5 degrees and the International Energy Agency Energy Outlook and Technological View. And they were very clear that if we are to meet the goal, if we are to have a chance to limit temperature rises to 1.5 degrees, then no new unabated generation of electricity or investments on unabated fossil fuel infrastructures could take place. Now, you see what you see in the slide. This is from the 2050 long-term strategy of the EU that is currently under revision. You can see how steep the lines are. Unfortunately, we haven't been listening to science over the past decades, and the task that we have ahead of us is much bigger than we would have liked to, much bigger than we were hoping for it, but it's the way it is, in the sense of this is what science is telling us, this is what we need to achieve. The big message is that what we thought for a long time that incremental steps we were going to get us to our objective. What we know now, and what the IPCC report left very clear, is that we need to take bold decisions and we need transformational steps. And this is what the actual the taxonomy reflects. Now, this is all not at all bad news and I'm going to go step by step. So the first thing, and still talking about the transition, I know it's a really, really important point for this audience, is that it was one of the TEC's big recommendations to the taxonomy, to the Commission, but also the Parliament and the Council, was the integration of the transition activities. The TEC recommended to divide climate mitigation into 3 types of activities: low carbon, enabling activities, and include transition activities. Now, that was fully accepted. It wasn't at the very beginning on the first draft proposal, but it was included in the final regulation. But it was a political agreement to define exactly what that transitioning activities should look like. And it's very, very clear, the regulation, that not only they have to be in line with that 1.5 degree scenario, but that they need, for an activity to be included, it needs to respond to the best performance in the sector. So we were given the mandate to really look at the best performance, the best technology, the best way of conducting one activity and include that, as long as it didn't hamper the development and deployment of low carbon alternatives, and at the same time, it was not going to lead to a lock-in carbon intensive assets, considering the economic lifetime of those assets. So that's really, really important to remember. It was a political decision to really make the thresholds as stringent. At the same time, both the taxonomy regulation and the taxonomy, the TEC's report, is technology agnostic. Both are technology agnostic. And when we set up the infamous, I should say, 100 grams of CO2 equivalent per kilowatt for electricity for power generation, it responded to science, and it responded, and there's no, as opposed to what, and I'm sorry, Inigo, I'm going to have to politely disagree with you on, there is no exclusion of oil and gas. There is simply saying that you need to meet the target and you need to meet the do no significant harm. Those thresholds are actually achievable through sequestrations and when there's no methane leakage. So there is room for maneuver, and what the taxonomy actually is doing is really encouraging investing in innovation, technology innovation, but also in the diversification of portfolios. The idea of the taxonomy is that you start with a low alignment on taxonomy from a revenue perspective, and I'll get back to this point in a minute, and you start lowering your emissions, and as you lower your emissions, your taxonomy alignment actually keep increasing. The inclusion of transition activities actually expands the traditional investment universe of green equity funds and actually green equity funds. Remember that the taxonomy #1 role was to inform the financial industry for its green financial products. I've been working in this industry for a long time, and I have never, at BNP for almost a decade, and we have never had a green product that has oil on it, so or fossil fuels on it, and is marketed as green. It actually does increase the investment universe, because we find activities that like industrial activities such as steel, cement, and others that normally don't make it to this type of funds. The taxonomy, and again, Inigo, sorry, I'm going to the taxonomy perfectly works at project level, and it operates, yes, at activity level. I would say it works bottom up, so at asset project level to the top. So instead of looking at the average of your carbon intensity of generating power, you need to think about your different plants and whether or not each one of those plants meet the threshold, and if so, then you can count the revenues, and that's how it operates. The other really important point, and also again, the taxonomy does not judge or assess companies, and I cannot repeat it more. It doesn't at all. It just looks at the activities that companies conduct. The taxonomy captures impact. It actually builds a bridge between environmental performance and financial performance, and it captures that impact. But it's not sufficient at all, and it doesn't aim to assess companies. I see the taxonomy as the perfect complement to the TCFD framework. The TCFD framework applies at company level, at entity level. It looks at the strategy, looks at the governance, it looks at the target set, it looks at the reporting, and so forth. So as an investor, when we will analyze an oil and gas company, we will use the TCFD at the different points. And then to capture the impact, it's when we will look at the taxonomy. Many of you have made, and I'm trying to look at, maybe I've been made in carbon neutrality commitments, but the taxonomy is actually, and this is a very important point, is telling you is that in order to meet those targets, what we encourage you to do is to invest in green hydrogen, in low carbon electricity production, in renewables, and so forth. And those investments, those expenditures will count as taxonomy compliant. The taxonomy is not only about revenue, it is primarily about expenditures and CapEx investments. And CapEx investments are absolutely essential for investors. And in fact, we look much more at the CapEx when it's available than the revenues for our funds, because it's a forward-looking and it tells us the direction of travel of a company. Then number 4, the taxonomy, and I think it has been quite clear. It's on one hand like a dictionary type that anyone can use as a reference point to know. So if it tells you that electricity generation is 100, the threshold, you can use it as a reference. If a company is 150, you know they're doing quite well because they're very close. If it is at 700, you know they have still a long way to go. It is a transition tool for the reasons I said, because it gives the direction of travel. It tells you where those activities should aim and look for. It is an engagement tool. We're starting to use it for our engagement with companies. We're just about to launch with the PRI an engagement initiative around the taxonomy. It is a policy tool because it is not only about the private sector. It is also about where governments stand in terms of their policy, to what extent they are coherent with EU environmental objectives. It is dynamic for transition activities. Thresholds need to be revised every 3 years. Overall, approximately every 5 years, the taxonomy needs to be updated to reflect the latest science, technology, and market dynamics, or any type of market evolution. And last but not least, it is really important to, as well, it is a measuring tool. The taxonomy, I was saying, for the first time, it captures environmental performance with financial metrics, that is turnover and CapEx and expenditures on the other side. It allows you for the first time to compare two funds. I don't know how many of you know, but it will be compulsory in Europe for all investors to disclose for the green financial products, or those products that have environmental characteristics, not for mainstream products. I repeat, not for mainstream products, to report the percentage of the fund that responds to the taxonomy. So that means that any of our clients will be able to compare two funds, apples with apples, depending on their performance against the taxonomy. I was precisely talking about this. I want to say that, of course, if you think about that, our clients will be able to compare apples with apples to funds. They will be or investors will be motivated to increase the percentage exposure to the taxonomy. That means that those companies who have a really high level of percentage some of them might become the must-haves, which also would allow us to include in the funds other stocks that have great valuation and maybe a low exposure to the taxonomy. And of course, one can wonder, in the long term, what is the impact of that in terms of access of capital. However, what I really want to highlight is that this is for not only for equity, it's also for fixed income funds. Then it would be the capex, the expenditures that we would look at, and not only will be included green bonds, but also normal corporate bonds. And we will take the report from companies on their capex that is aligned with the taxonomy. I also want to highlight that it's almost a given that credit institutions would also have to report on the taxonomy. So that gives huge opportunities for oil, gas, and companies that are looking to diversify their portfolio to use green financial products, in order to finance their transitions. Those products are highly demanded. We have already identified that there is currently a greenium in the market. Imagine in the long term. And last but not least, but I was just speaking about that increase of demand on green financial products or products that have environmental characteristics is just going to grow, because the taxonomy is the base for the EU Green Bond Standard, but it's also not only for the EU Green Bond Standard, it's also the base for the Eco Label, which is for the retail market. But and any member state that wants to develop a standard or a label for green financial products will have to use the taxonomy as the base. Now, the importance of this is double, because you also need to link it to the rest of the regulation of the package, sustainable finance package that is today on the table, and what's coming with the renewed sustainable finance strategy. So in terms of right now, one of the most important pieces of legislation is the ESG preferences and suitability test. This means that by law, we will have to ask all our clients, retail institutions, for the ESG preferences. And if they their interest or they have a preference for environmental, we need to put forward products that have an environmental objective. And as I said, if they will then see the taxonomy, the percentage of alignment of the taxonomy for each one of the products, and decide upon that. I also want to finish by saying that that in the new proposed, in the renew strategy, and what the current debate is on the role of the public sector, or to what extent the public sector needs to take the taxonomy on board, not only for public link pensions and central banks investments as asset owners, but very much for the green procurement, green budgeting. This is very much under discussion now because of the green recovery, the recovery package. The Commission already announced that the taxonomy will guide that package, and today, explaining how we see, which role we see of the taxonomy, the role that we see for the taxonomy in the recovery. And with this, I think I've talked long enough. I will leave it with this. I'll be more than happy to take any questions, but just really want to highlight that the taxonomy is not a hinder for this industry. It's actually an opportunity for oil and gas companies to be helping your efforts to transition and to finance costly transformation plans, and to help you achieve the goals of the Paris Agreement. Thank you very much.
Thank you very much, Elena. It has been an excellent explanation for us for a better understanding of the taxonomy and its impact in our industry. Well, if you allow me the joke, we expect not being the taxonomy a dictionary with the O of oil missing. Let's move on to next panelist. Now we have Lee Clements, who is Head of Sustainable Investment Solutions within FTSE Russell, being responsible for multi-asset green investment research and product development. He has previously held different management positions at PIMCO, Impacts, Nomura, etc. Dear Lee, thank you very much for being with us. Please let us know about the FTSE Sustainable Finance approach. How does it align with the EU taxonomy? And how do oil and gas projects fit in it? And finally, I would like you to please share with us your take on the EU's new Paris-aligned and climate benchmarks regulation. Thank you very much, Lee.
Sure.
The floor is yours.
Thank you very much, Inigo and Helena and everyone out there. It's a pleasure to speak to you guys at this, I was going to say conference, webinar, given the current situation, because I think that you are an important element in the way that this works, both from a regulatory and industrial and a financial point of view, is very important. And at FTSE Russell, this is something that we've been involved in for a long time. I know that the current EU taxonomy situation has put these kind of green products and services very much in vogue, but we've actually been running a broad green taxonomy since 2008 with full set of data behind that, and it's been used in financial products. It's had various guises and names, from the environmental markets classification up to the second generation green revenue classification, which we will be launching in September. So we've been looking at this area for quite a long time. And I would argue, in terms of what you were saying earlier, Inigo, about financial versus non-financial aspects, whilst an element of this is about sustainability goals and people looking at it for that reason, for the last 15 years that I've worked in this space, both on the listed and the unlisted side, I would say there's actually been a larger use of this product for financial goals, i.e. to try and invest in areas that are growing, backed by government subsidies, backed by increasing demand from industry to generate financial returns, as much as to achieve sustainability returns. So I don't think you can see this purely as in, how does this help us achieve a 1.5 or 2 degree scenario or ESG return. Certainly for myself as an investor, you know, I spent a long time as a portfolio manager before I joined FTSE Russell. I would be looking at these topics as in, how can it help companies to grow both revenues and achieve more profitability than some, you know, other parts of the industry that aren't growing quite as fast. As I say, we've been doing this for a long time, and at the moment, you know, the number one topic in the market around this area is alignment with EU taxonomy, and there are multiple objectives there. And from my own point of view, I was one of the second round technical experts in developing the EU taxonomy. I've got another 2 colleagues who I work with who were part of the TEG in developing the taxonomy, and one of my other colleagues was part of the higher level expert group, which was the precursor to the TEG. So we've been involved in this. What I would say is that the EU taxonomy isn't really finished yet. We've covered climate mitigation and adaptation, but there are other very important elements still to be looked at, such as circular economy, such as pollution prevention and control, such as the water segment, which I think will be very important, particularly to the oil and gas industry, where water issues are very important, pollution prevention issues are very important. You know, if you just look at the issues around diesel cars, it's not really a climate change issue. It's more a localized air pollution in urban environments issue. The solution may be the same as the climate change solution, but that's really what you're looking at there. And we try to combine that data where we're trying to kind of very much look at the green products and services in line with some of the degree of contribution, the degree of do no significant harm. And we also try to look at it in tiers as well, because we look at this very much from a bottom-up point of view. We go out and look at 16,000 companies. We find about 3,000 of them that have some range of green products and services, including almost all of the major oil companies have some degree of activity within this. But there are also other elements of some of these activities which have environmental negatives to them as well. So we try and look at them in terms of the level of contribution within that across all of the green objectives, which can be quite important. But one of the things that I would say, and I would kind of beg to differ with Helena on this point, is I don't think the green taxonomy really is the be-all and end-all of looking at these things. Both within the sustainable investment world, there's been an evolution of the way that people look at sustainable investment, broadly starting off looking at divesting of things, particularly things like coal and oil and gas, then looking at relative levels of carbon emissions, now starting to bring in green revenues, although there have been investors doing this for more than 10 years. And you're really looking at different areas of the same kind of equation here when you're looking at these things. For instance, green products and services that the EU taxonomy looks at, and I think it does look at transition a little bit, but takes a very narrow view of it. Green products and services really only cover about 6% of the global listed market, but there's another 94% there that are using some of these products. And I think that the oil and gas sector is a very good example of this, where it's a very high carbon sector, but a lot of the green products and services that are highlighted within the EU taxonomy and within our green revenues system, the oil and gas sector is a major purchaser of those products and services to reduce the pollution or carbon intensity of some of its activities. And when we look at transition at FTSE and at the London Stock Exchange, we're really trying to differentiate what a company does with its products and services, which is really, where green revenues or an EU taxonomy looks at things, and what are they doing within their internal operations, and to what degree are they making those more sustainable? Because really, when you look at that graph of increasing taxonomy alignment versus decreasing emissions, it's not just really going to be taxonomy alignment that's important. It's going to be the fact that the people who buy those products and services are actively reducing their carbon emissions, be they an oil and gas company, a food producer, a supermarket, whatever it is, because a net zero commitment is going to apply equally across all areas of the economy. So on the right-hand side of our slide, and this is in line with some of these new benchmarks that the EU are bringing along, we're looking at combining things like carbon emissions intensity, fossil fuel divestment, green taxonomy-type green activities, with what we call climate governance and transition alignment. And there's a product that we launched recently together with a Transition Pathway Initiative group of investors, where we're specifically looking at high carbon areas like oil and gas companies, and to what degree are they actively addressing sustainability and in particular climate issues and enacting them within their policy. So do they have CO2 goals? Are the CEOs, the senior execs remuneration linked to some of those goals and so on? Things that we hope will be a forward indicator to the level of carbon emissions there. So, that's quite a different way of looking at things than from a kind of taxonomy product activity alignment point of view. But we think that those are all important to investors, and a lot of our investors are kind of asking about that. our green revenues taxonomy, which broadly covers the same areas as the EU taxonomy, but extends into water and circular economy and pollution control. It covers a lot of different sub-activities. There's about 130 different sub-activities in there. And, you know, as I was saying, not many of them overlap with what oil and gas companies do, but they will inevitably end up being a purchaser of quite a lot of those products and services. The real challenge, actually, within the EU taxonomy is measuring it. There's a very low level of disclosure of data from companies, particularly in the listed markets, which allows you to properly measure the level of green activity within a company in relation to its revenue. So I think how this aligns with disclosure will be a very important element of this. And the EU Joint Research Centre used some of our data to kind of look at what kind of impacts the taxonomy might have. And going back to kind of why people look at this and kind of financial versus non-financial reasons for this, as I was saying, it is now a substantial part of the economy, about $4 trillion of listed equity market cap, we believe, and about 6% of the economy of the listed equity market. But we should, as I was saying, remember the fact that there still leaves 94% of the listed equity market that still needs to address transitioning around climate change. But it is a growing area, and it's almost as big as the oil and gas sector at the moment from a listed perspective. But it's not just about renewables. So it can cover a lot of different areas. As we were saying, we cover water, pollution control and so on. But what we find by far the biggest element is energy efficiency. And those energy efficiency elements can apply very much to industrials, oil and gas companies, power utilities as well. And lastly, the other reason why investors have looked at this over the last 15 years that I've been involved in this has been financial performance. So this is an example of the green line is the FTSE Environmental Opportunities All Share, which tracks about 500 companies who have 20% or more of their revenues coming from green products and services, which should be in line with the broader EU taxonomy once it's covering the areas like water and waste and so on. And that has outperformed both the oil and gas sector and the broader market, the FTSE Global All Cap, over the course of the last 17 years here. We actually launched it in 2008 and has actually outperformed by about 3% in the recent crisis from March, for the 3 months from March to June. So again, I would say here, this isn't just about people looking for a lot kind of ESG alignment and sustainability goals. People are looking at this from a financial performance and return point of view as well. So I will leave that there because I've used kind of plenty of time talking, and back over to you, Inigo.
Thank you very much, Lee. Very interesting presentation from your side. Thank you. Well, we have to move on to the last panelist. We are running a little bit out of time, but let's hope we can stay here for some more minutes for the Q&A. Everything is so interesting that it's not possible to interrupt the panelists in order to speed them. Well, let's go for the third and last panelist, Rachel Bonfante. She's manager of ESG and sustainability with Chevron. She joined the company in 2014. In her current role, she is responsible for leading and advancing the company's sustainability reporting, human rights, and emerging ESG issues. Prior to this, she held several positions as EU Affairs for Chevron and also for Equinor and for IOGP. Rachel, thank you very much for being with us, and please share with us the way you see EU's taxonomy from an oil and gas point of view and the risks and opportunities that, in your opinion, may arise. Thank you very much. The floor is yours.
Thanks. And just in the interest of time, I'll try and just focus on a few of the key elements that from an oil and gas sector perspective we see and we've been engaging on over the last couple of years. But I want to start just with a little bit of context, because I think it is important. Helen touched upon this at the beginning, but the reason why we're all embroiled in this debate around sustainable finance is really that EU target of net zero emissions by 2050. And then in particular, the three pieces of legislation, the three big goals that there are for 2030, just to cut at least by 40% GHG emissions, to have a 32% share of renewables in final energy consumption, and then to have 32.5% energy savings. So the reason I've gone back to this bigger policy framework at EU level is because when you set very ambitious targets like that, and they are very ambitious, you've seen earlier on some of the speakers showing just how much of a trajectory we have to reach those goals, there is a huge investment gap. And I think this is sometimes underestimated. So we have, as IOGP, we've always emphasized that really what we're looking for is between 175 and 290 billion euros a year to reach those goals just at the EU level. So that's why the EU has really focused on the role of the private sector and private financing to try and help reach these goals, because public financing, particularly now with the economic slowdown and COVID, is just not going to be sufficient to get there. So just from the outset, to make it clear that IOGP, the sector, we really do believe that we can contribute to those goals. We believe we have to. Helen has given us a very strong challenge in terms of seeing this as an innovation gap that we have to address. But we also do have some concerns that right from the outset, the sector is really the contribution that we can make is really being put to one side. It is going to be a challenge for us to find some space, I think, within the sustainable finance agenda. So if we think about the taxonomy, the key element, as we've heard from the other speakers, is just what kinds of economic activities can be classified as sustainable, with those very detailed, very tough metrics and thresholds. So we know, for example, that there is a lot of CO2 savings from switching from coal to gas. It's something that we've been engaged on very heavily as IOGP. But under the taxonomy, you will have seen that CCGTs, for example, by themselves don't reach that threshold to be considered environmentally sustainable. The way we look at the taxonomy regulation as IOGP is to really focus particularly on that middle purple block there, the transitional activities, which Helen focused on as well a little bit. These are probably the most important element for us. This is where we see the space for the things that we do as IOGP members every day. We'll come back to this a little bit more, but we do really think that the fact that the transitional activities and the enabling activities have been incorporated and are part of that taxonomy regulation, that's really the opportunity in the space that we have as an oil and gas sector. So we see the transitional activities as a subcategory. The TEG report, the Technical Expert Group report that has come out, which Helen was part of, is silent about these transitional activities. And we think this is really a mistake and, as I've said, an opportunity. A second element for us, and this is a little bit where there is sometimes a contradiction between, on the one hand, very tough targets and thresholds, which seem a priori to exclude the oil and gas sector. At the same time, there is this idea, as we've heard, about technology neutrality. And this, for the oil and gas sector, I think is a fundamental principle. We have such huge targets to reach. There is such a need for transformation and for a lowering of carbon emissions that any technology, absolutely any technology that has the potential to reduce CO2 emissions, we think it is absolutely vital that that has a space within the taxonomy to contribute. So I do disagree, Helen, with the idea that we've heard from several quarters that there is, if the oil and gas sector is included, there is going to be some lock-in effect. We do not think this is the reality. The sector is changing rapidly. We're making big investments in new technologies. We have that eye always on innovation. So any technology, as I've said, which allows us to do that over time should be part of the taxonomy scheme. Third point, I've talked about the delegated acts and those transitional activities. These are really important. And just to give a little bit more detail here, we think those transitional activities really need to have very feasible and near-term steps that then can allow us to build up to those longer-term Paris Agreement and EU climate change targets over time. So just to give you an idea of some of the things that we believe should be included in transitional activities. So there is those low-emission fuels that many of the IOGP members are very focused upon. Not only that, but also the refueling infrastructures, whether that's for biofuels or for LNG. Use of LNG in public transport more generally, we believe that has a very important role. For example, in sectors like shipping, that needs to be very clearly included and recognised. Likewise for natural gas, whether that's combined heat and power or whether it's the ability to add on carbon capture and storage technology to existing natural gas power plants. So finally, I'm going to wrap up. I know, Inigo, we're really running out of time now, but I think one of the overlooked factors, not only for the oil and gas sector, but I think more generally for the financial sector, everybody who is captured within the scope of the taxonomy regulation, we have a real challenge in terms of being able to really understand exactly what information we're going to be asked to disclose and being able to do that on time. So we've got a timeline crunch. The implementing rules, the delegated acts, will not be finalized until 2020, but yet the disclosure obligation kicks in the middle of next year, in the middle of 2021. So we as IOGP have asked EU policymakers to really think about this. It is something that is brand new. The EU is leading the way. There's no other jurisdiction at the moment globally that has the taxonomy in place and all these really stringent requirements and technical considerations. So we have continued to ask policymakers to think about, is there a way in which we can have a couple of years as a pilot phase, just to make sure that everybody is reporting the information. We as oil and gas companies are providing the correct information in the way, in the format that financial institutions are going to be asking us for that information. Or perhaps is there a way just to extend the timeline? And I think particularly given the challenges that are facing our sector with the low oil price, the economic recession and the challenges of COVID, this is really something that we would like to see. So I think there is, as we've talked about, there are still some elements where we do feel that the oil and gas sector concerns have not been really taken into account as much as they should be. I think that technology neutrality is the key thing. And then the second issue, just to reiterate, is the importance of making sure those transitional activities are well defined. They have their own screening criteria so that we in our sector and as IOGP members can really contribute and make this happen. And I'll leave it there, Inigo. Thank you.
Thank you very much, Rachel. I think it was an excellent overview of the way our industry is foreseeing the EU taxonomy. And I think that even though we don't have enough time to be closing this webinar on time, we should be staying here for 10 more minutes if everybody is able. And if so, I would like to start with a certain reply from Elena and Lee to what Rachel has just introduced, because being this a representation of the oil and gas point of view and taking into account that it has covered a lot of the things that are happening through the Q&A in terms of both questions and comments, maybe it's useful to start with this reply. I will ask Elena and Lee to have only 2 minutes each one of you to reply about this last presentation held by Rachel. So please, Elena, can you start?
Yes, thank you so much, Inu. Excellent idea. I'll go, I have marked 6 points of reply. The first one is on, I fully and very politely disagree with the point made that we did not include transition activities. In fact, the transition is at the very core of both the regulation and the report. And I stress again the fact that it was the tech who included the transition activities, that there was finally in the political agreement, final political agreement, and today in the regulation. Now, what I do, and I take the point, is that we might have a disagreement on what type of transitioning activities should be included and what should govern that. I just reiterate the point about that the lock-in emissions and the conditions of being how or which activities should be included were imposed at a political level. That was a political decision, and what we did is respond to that, decide if we want to be part of the 1.5, if we want to meet the 1.5 target, we cannot afford, as you said, unabated new infrastructure, fossil fuel new infrastructure, or power generation. But there's plenty of space for great innovations. I highlighted green hydrogen. We believe, and now speaking as BNP Paribas, we believe it is great. It has great potential, and we very much would like to finance more of it. I also mentioned CCUS. We think sequestration can play a key role, and we can talk about other technologies as well. Third point I wanted to make is that we seem to be quite focused on the taxonomy. The taxonomy is compulsory, again, only for green financial products, or those financial products that say that they have environmental characteristics. The other piece of regulation that seems to pass unnoticed is the disclosures and the change on fiduciary duties that actually will have a much bigger impact, because when you look at the indicators that have been published that will govern the disclosures regulation, you see it will become compulsory at entity level and at product level to disclose, for instance, the energy mix, the share of energy developed from fossil fuels, and so forth. So I think that you need, as an industry, to start thinking more globally of what is the impact of the entire sustainable finance package, where the taxonomy actually is a tool that can be really helpful for this industry, again, as I said, to access green finance, particularly when it comes to debt products. The other point I wanted to make very quickly, and this is in response to something that Lee said, is that I never said the taxonomy will become, the only indicator. I said it very clear, the taxonomy will replace the current taxonomies that are there at EU level. That's undeniable. It's already the case for the European Investment Bank. As I was saying, it's going to play a key role in the recovery. There will be obligations for member states, and everyone is starting to apply at European level. However, it is only one indicator of many. And as I said, the TCFD framework continues to be, and we will continue to push the framework to assess companies. We are part BNP Paribas, a key partner of TPI, but one of the big funders. But TPI works differently. It is a company level, looks at quality of management and about the pathways of the companies. Here again, we're talking about activity assets projects. Thank you.
Hi, thanks very much for that response there. I personally would agree with Rachel that I think that the taxonomy hasn't included transition activities to any great degree. We've been engaged with the EU on this, and we think that you can separate transition from activities because green activities are a narrower subset, but you've still got the rest of the global activity, global economy, all of which needs to transition to lower carbon activities, but that we don't think that you can see them both with the same lens. And actually at the moment there is a slight mixing of the two, where you, for instance, do have lower carbon within the taxonomy, but you don't have lower carbon kind of oil and gas products within there. So that's one point that I would look at, that would say that I think that actually you need to keep those two separated, but both equally important. And in terms of climate finance flows, which I would agree with Rachel are very, very important in order to kind of achieve 1.5 degrees. I think it's very important to make sure that those flows cover all aspects of climate activity. So not only going towards companies that make green products and services, which is basically what the EU taxonomy highlights, but also help to go towards the companies which are buying green products and services and using them, which is what a TPI type kind of real transitional approach would look at. So I think you need to look at both and make sure that the climate financial flows are going towards both of those areas. And I think that they are both very important to investors, because, to be honest, with the best will in the world, very few investors would buy an oil and gas company as an example of a leading green technology, except in a few cases. But a lot of investors do still want to be exposed to the oil and gas sector, but they're looking at it from a risk perspective, which companies are transitioning the best. And I want to be in the companies that are transitioning the best, because they face the lowest risk of being forced out of the market, be it regulatory point of view or additional costs of carbon border taxes or whatever it is there. So I think it's important to look at more than one indicator in order to look at both risks and opportunities and what it means for future investments. Ultimately, that should drive a lot of the financial flows that are needed to meet the climate crisis.
Thank you very much, Lee. It's 8 minutes past 4, at least in Madrid. That means we are 8 minutes behind schedule. So I think that I would like to go on with a couple of questions, if it is possible. Can the organizers tell me if we have the chance? Camila, Jack, Jim?
Yes, we can continue, I guess.
Okay, then let's keep on going. Just for some moments. I have to say thank you, first of all, to everybody that has been putting some questions or comments in the Q&A box. I would like to start with this one. Refining of and sale of oil products is not included as taxonomy eligible activities currently. Is this just a misinterpretation of the technical screening criteria? It's again related with the O missing in the dictionary. I think Elena could be trying to answer this question for us.
Okay, thank you. I mean, I'm trying to think that maybe I don't articulate myself sufficiently clear when I say that the transitioning activities are included in the taxonomy. But what we need to understand is that taxonomy is like a procurement plan for 2050, yes? And it is looking at those activities, at helping the different activities to become carbon neutral. So when we look at And again, when a company, and I think there are several companies that in this call that have made recent announcements on their carbon neutrality, that they are committed to carbon neutrality by 2050, starting with Repsol, correct, Inigo? So when we look at a company like Repsol, what the taxonomy is telling Repsol is that you can use the taxonomy to invest, to diversify your portfolio, to invest in green hydrogen, in the infrastructure for electrical vehicles, as is the case that you have done, in renewables and so forth. And those investments and those expenditures will be taxonomy aligned, but not, other. If you invest in CCUS, brilliant. And if you meet the target for power generations, then with CCUS, that gas will be taxonomy compliant. And that's what the taxonomy is telling you. The taxonomy, once again, is not governing all finance flows. It's only looking at green finance and about any finance that says that has environmental characteristics. So there still will, if on top of it, Repsol wants to reduce the emissions of the refineries, that is great, and there will be a financial market for that. It just cannot be labeled green. And to be honest, it has never been labeled green, at least by many of us. So I think that there is there is a misunderstanding of what the role of the taxonomy is. So that's one of the key points. And again, in the taxonomy, there are plenty of activities that are related indirectly with the oil and gas industry, or more directly, which are included. I mentioned green hydrogen, CCS. From the top of my hand, there's the storage pipelines, and of course, it needs to meet certain guidelines. But it is the same for many other sectors. I don't know if you want me to go more into the details, then I can go into the details of more the technical aspect of it. But I think that it is quite clear of how the taxonomy can be useful for this sector.
Thank you very much, Elena. I think that the answer can fulfill what the person asking was expecting from you. Maybe someone was trying to say
very
something.
Quickly? Very quickly. Just want to say, for instance, LNG sector in Europe. I mean, the LNG sector with CCS, it's more than likely to be included, because the energy sector has been much better at calculating methane emissions. It has been really good at controlling methane leakages, gas leakage. So if CCS or CCU was to operate, it would be included. So once again, it is not excluded. It's just that it needs to meet the thresholds and the conditions. Sorry about that. Thank you. Over back to you, Inigo.
Thank you very much, Elena. I have another question, and maybe both of you can answer, but maybe I would like to start from Lee. From January 2022, companies will have to report the degree of alignment of their activities with the taxonomy. Is taxonomy then going to be used as a tool to label companies? And in this situation, can the financing of a certain green project be conditional to the kind of company that promotes that project? Please, Lee.
Well, I mean, yes, disclosure is going to be one of the key things, and it will absolutely be important to have more data there, because there is a real lack of disclosure within the market. How some of these things will work will depend upon how investors and regulations take this up. The EU taxonomy, as Helena was saying, is one of the the kind of bedrocks of the EU green bond standards. So the degree with which you want to kind of finance a project at a better rate for something that is involved in something related to the EU taxonomy, that will be an element of that. However, that is dealt with more directly at the bond origination level rather than public disclosure level. There are, kind of from a public disclosure level, I think that will certainly be something companies are rated on, and they are rated on it already. And there are already ourselves and other people who have been measuring for years the degree with which oil and gas and any other company perform from an exposure to the green markets or to brown markets for that matter. How that relates globally to the EU taxonomy is an interesting broader question. We're talking very much about the EU here, but we should view this in a global context. And it's one of the challenges for us as a data provider. We've had a taxonomy for 12 years. Other groups have taxonomies. We've now got the EU taxonomy. A month or two ago, China launched a green taxonomy. I believe that Canada are also working on a taxonomy. So there are likely, at least for the foreseeable future, to be multiple taxonomies. They'll probably be very, very similar at the end of the day. But there will likely be a number of them. And but increasingly they will be important to accessing funding, because there will be lots of banks and groups who will look at how these things fit in with their financial reporting. And with Helena's point around TCFD, the degree to which they align positively with some of these elements will help that. And it will probably help even more if it's a project that's looking for some kind of semi-public type funding, where this will probably be even higher up the agenda.
Can I quickly add a few points around the labels, because the taxonomy has no minimum percentage requirement attached to it. And as I said, its activity level, it puts no labels whatsoever on companies. However, the taxonomy is the base, as I said, for any label or certificate or standard that national or member states within the EU and the EU sets for green financial products. So it's at the level of the financial product, the label. The EU Green Bond Standard would have to be 100% taxonomy compliant. There's only an exception for R&D, and there will be a verifier. So the percentage of, so the reporting has to be public, and there will be an impact reporting that has to follow the template of the Green Bond Standard. On the international, in terms of a global taxonomy, just to say the Asian region, so just to add to what Lee said, led by Singapore, is working on a taxonomy and is taking the EU taxonomy as a base, and is looking to what extent, in which areas it might have to be adapted to the local context. The same is happening in Colombia. Lee mentioned a few other countries, just to say to everyone that the Chinese taxonomy only applies for green bonds and is up for a consultation. It's still ongoing, but I would like to finish by saying that the Commission launched an international platform on sustainable finance on October 2019. And on that platform, there's 50% of the global GDP and a global population. And one of the key tasks of the platform is to work towards a harmonization at global level of the taxonomy and other type of financial related regulation. Thank you.
So let me just jump in, if I may, because I think Lee and Helen both touched upon a really important point here. The other pieces, the other ecosystem around the taxonomy, in particular, I think the disclosure elements are going to be really the key thing. And here, to go back to a previous question about the exclusion of the fossil fuel sector from the outset of the taxonomy, just because of the way the criteria and the thresholds have been designed, I think that's true. But one of the challenges, I take your point, Helen, the taxonomy is technically focused on green products or products that have some kind of green claim in the financial space. But given the amount of ESG information that's out there, given the increase in disclosure that the sustainable finance package in the EU will also drive, I just don't think it's realistic that the idea of some economic activities being sustainable and others not sustainable is just going to be limited to the EU or is just going to be limited to a certain set of financial products. This is one of the reasons why IOGP has been so heavily involved in this debate, is because we know as companies that the financial sector is global. It operates across borders seamlessly in terms of allocating capital. And so one of the things we are concerned about is that knock-on effect in terms of the broader financial system and how oil and gas companies, how IOGP members are really assessed and analysed in the future. That's one of our biggest concerns and watch points.
Thank you very much, Rachel. I would like to raise another question, which is the following, and maybe this is something that both Elena and Lee can try to answer. What is the opinion about the current state of the oil and gas players regarding the EU taxonomy requirements? How much are we in good or bad shape? And what would be the conditions for your companies investing in an oil and gas company?
You want to start, Lee?
I can happily start here. I mean, we're not an asset manager, so we don't directly invest any money, but we create the passive products and indices which kind of include or don't include certain companies and which other people then use to invest in. How does that align with the green taxonomy? Yeah, as I said previously, if you're looking at the any green taxonomy in isolation, be it the EU, green revenues, or whatever, there's very unlikely to be very much exposure to a green taxonomy, in as much of green taxonomy is defined as those kind of products and services making a substantial contribution towards climate change, climate mitigation, and so on. Within our database of 3,000 companies, almost all of them are in there, but they have a fairly small percentage. I had the enjoyable time going through the back pages of Chevron's annual report to try and work out what percentage of revenues was coming from your Indonesian geothermal plants, and to be honest, I think it was quite small. In terms of labelling companies, you inevitably have a degree of labelling here because you measure them based upon a percentage of revenues or capex or whatever, and you set a threshold. We have two thresholds on our indices: 20% of revenues and 50% of revenues. And then they tend to get viewed by the market then as a green company or not a green company. And there would be, I think, pretty much no major oil and gas players that would be 20% or 50% green, even if you were far more relaxed in terms of what you put into a green taxonomy. I think it would be a struggle unless you went hell for leather saying all gas. But I think that would be a very difficult sell to a lot of end investors. But I would then come back to the point of, for accessing, both sustainable investment climate flows, it isn't about a kind of green taxonomy for oil and gas companies. It's about to what degree are you kind of actively involved in transitioning your business towards lower carbon solutions. So for us, when if somebody is very interested in the oil and gas sector from an environmental lens, they will be tending to look at our index products from the point of view of, to what degree is the carbon intensity lower than other peer oil and gas companies? To what degree is the carbon targets more aggressive than other peer oil and gas companies? They may also look at, are they expanding into other businesses that are EU taxonomy compliant or kind of green compliant to, as a risk mitigator. But to be honest, given the current size of the oil and gas sector, it is, difficult, even if you're someone like Total, who bought SunPower, bought Saft and so on, to have a business that is comparable in size. And to be honest, if you look at some of the climate transition benchmarks the EU have got, they tend to look at it in terms of what's the balance of green activities versus brown activities, and oil and gas tend to be in the brown activities. So even if you're doing quite green activities, if you've got a more polluting activity on the other side, they do net off to a certain degree. But the more sophisticated investors, are actively looking for oil and gas companies who are addressing the challenges of climate change, as Rachel and yourself have talked about, and are addressing them in a way that is measurable for the financial market. But that is quite a different thing than saying, are they a green company? Because you're not generally solar panel manufacturers or water filtration manufacturers or whatever. Gas is the point that's more arguable. And sorry, I know I'm going on for a long time. From a pollution control point of view, we have been looking, and from our green revenues area, we do look at coal to gas switching, but we tend to focus it on a regional perspective, because for us, that's not so much a climate change issue. It's an urban air pollution issue, where some of the solid fuel regulations that are in place in the developed markets are not yet in place in places like China and India, and they're actually addressing those with the use of gas instead of well, that's a very narrow example.
Right. I try to be quite succinct. I think that for us there are two key issues when looking at the oil and gas. One is the economics, and the other one is the sustainability angle. So from the economics point of view, for us, this is an industry that is at its crossroads. I think that even before the crisis, already the demand was declining. The long-term demand was declining, especially in Europe. The crisis has seen collapsing demand and oil prices falling into what we could call negative territory, and we see that in the medium long term, what the industry needs is to move from oil and gas companies to become energy companies. I mean, this is not only us saying it. The CEO of Total made it very clear the market is not that of oil, but of electricity. The CFO and CEO of Shell and other of the biggest companies have recognized that there's been major demand destruction, that it hasn't been the same in the renewable space, that they need to transform, and they need to start making investments into, all sort of renewables, but also, and mentioned over and over, carbon capture, use and storage, but it's also about plastic recycling, it's about LNG, it's about green and blue hydrogen, and so forth. So the economics are telling us the same as the sustainability. And what we think is that the taxonomy provides these companies a tool to guide the transformation. And I won't repeat that. When analyzing the companies, we also look at the quality of management, the governance, the strategy,
Elena,
the target
sorry.
set, and so forth. Yes, we need to cut. I'll leave it here.
Yes,
Thank you.
I have, excuse me for this, but I need to cut if we just want to say goodbye. In 15 seconds, we're going to be automatically cut. So
Yes,
thank you very
you.
much, everybody. Thank you very much for to the panelists, and let's hope this has been interesting for all of us. Goodbye and have a nice day.
Thank you.